Welcome back to Radically Rational Radio. In this episode, we're going to cover why all of these banks are failing all of a sudden. And I think the reason is going to surprise you. Let's jump into it.
So, Dick, I don't want to be too critical on Jay Powell, okay? I mean, we know interest rates are probably the gasoline on maybe a fire that was already there due to bad management, like Michael Milken. I don't know if you saw our interview with him yesterday. He said this is just basically banking 101, and they screwed it up. Is it possible the banking system that Powell described is, quote, strong, but at the same time, these stocks clearly are not?
The banking system is not strong. The banking system is dealing with a systemic problem, no different than what we saw in 1986 with the SNLs. The problem is that interest rates are going up, and when they go up, they cause the cost of deposits to rise at a rate which ultimately reaches the point where the banks are paying more to bring money in than they are getting from the investments that they have. The second thing that the rise in interest rates do is they drive the value of fixed rate assets, treasuries, home mortgages down. And what that does is it robs the banks of liquidity, which means that when the depositors come banging on the door looking for their money, the liquidity is not immediately available because it's wrapped up in areas which can't be accessed, quickly, number one. But number two, that the value of the assets are not what they say they are. Number three, the banks are cheating in the way they report their balance sheets. When you pick up the financial statements of the bank, that financial statement is not what the bank owns. That bank financial statement is showing more assets than the bank has. It's showing more equity than the banks had. And thank God for short sellers, because what they're doing is what the Federal Reserve, the FDIC, and all of the regulators should have been doing. They're cleansing the system.
Well, that's it. And Nick, let's forget about the big Fed for a minute. Let's go to the baby Fed. The San Francisco Federal Reserve, under the auspice of Mary Daly, with the exception of Signature Bank. All these banks that are failing, by the way, and this one hasn't failed yet, but basically they put up the red flag today, they're all under the regulatory purview of the San Francisco Fed, which I believe used to have two actual bankers on the board. Now it maybe just has one because Silicon Valley Bank CEO is out. I mean, do we need to start, do the CNBC or the Wall Street Journal or both need to plant some reporter at the San Francisco Fed for the next couple of days and be like, what's going on? We had you on over a month ago. We've been talking about it. I've been tweeting about it. We've had many guests who've come on in the last 6 weeks and said there's still a lot of problems, and we haven't heard anything from the San Francisco
Fed is a total disaster, and it goes back 50 years. It's not something that you can say these three banks here. You can remember, you come from California, H.F. Amundsen back in the old days in the SNL industry. You've got Countrywide Credit. You've got Washington Mutual. Some of the biggest disasters continuously come from Janet Yellen's and, Mary Daly's San Francisco Fed. Something needs to be done about that Fed. However, they did not create this crisis. This crisis is created by the fact that interest rates went up more rapidly than the banks could handle, and therefore the banks were if you will, naked when the storm hit them, and they're now getting hit by it. Nothing has occurred to change the situation. The situation only got a tiny bit worse today when the Fed increased, the rates by 25 more basis points, adding more fuel to the fire. But the fact of the matter is, no one in Washington is doing anything to ameliorate this crisis. And this crisis will continue to go on until something is done to solve the problem with the fact that interest rates are going up, that are causing deposit prices to go up, which is causing asset values to go down. I apologize for repeating, but that's the systemic problem. And that's what's not being impacted.
I really appreciate how eloquently he put it. All of the banks were over-leveraged, and now interest rates are finally going up, and there's about to be a great reset. I am an Austrian economics absolutist. I've been saying that we should be raising interest rates since before 2008. This was always going to hurt. This was always going to hurt. The fact that we've just been keeping ourselves high and drunk on cheap money is the cause of this leverage. You're probably thinking this is entirely the bank's fault. Let me ask you this. If you owned a business and your business model was making money on money, the two ways banks have been making returns primarily for the past 50 to 60 years is on mortgages and treasury bonds. We've been creating money at 0% interest on these two things for 25 years and no cost of money. Now you probably think I believe that this is some huge conspiracy, a group of people on an island that have been planning this for 25 years and they're just now pulling the trigger. No. There are a lot of different players on this board. Some individuals, some family offices, some countries, some political families. In my experience, the bulk of the hyper-wealthy people that are removed from actually creating money but merely making money with money seem to be globalists. There's no benefit to them believing that America being great is useful. They just need money to make money at any cost. They set the board up, they make sure it's really enticing, and when everyone's playing real hard and feeling real good while being leveraged up to their eyeballs, they just have to finally allow interest rates to go back up. How else could you plunder so successfully without war? Give free money, allow a bunch of people to create valuable assets, then make it just a little too expensive, and then come like a debt collector. It's shameful. It's what's happening. And again, we need to go through this process. Not for a single second will I say we should reduce interest rates. We should create a bank that actually banks. We should create companies that actually make things. Clearly the gig is up. Moving money left to right and capital ventures are not the current best way to get real financial independence. Currently, the Fed is basically mirroring European central banks' interest rates. I think they're going to go to 5%. This looks like a great reset of assets and private property. For us to own nothing, we first have to have everything taken away. And this right here is a massive centralization of assets. If you can find land, go buy land. If you have a house, don't sell it no matter how much they offer you, and make sure you save to pay your taxes. This is a war on property, and only the individual can assess their life and their situation and make the best decision. That's what individualism is. That's what personal responsibility is. I hope you learned something. I'm Tristan with Radically Rational Radio. Like, comment, subscribe. I'll see you in the next episode. Stay resilient.